50 years and 3 bear markets. So over the last 50 years, we've gone through 3 bear markets. And I'm defining a bear market in this context as down 50%. So massive bad market. Now, a traditional definition of a bear market is a 20% loss. I would argue that 20% losses can happen pretty frequently in the markets, but we're looking at, I don't want to say, I guess it's a major bear market, and we're looking at losses of over 50%. So after over the last 50 years, we've had lots of different drivers of success for the economy. And if you look through these headlines, you can see it's pretty remarkable when you look at what was dominating the 1970s. It was really the oil market and the metals market. You know, gold was skyrocketing and oil prices were skyrocketing. Through the 70s and 80s, we had the rise of home computing and personal electronics, right? That was a massive push. And then in the 90s, a new generation of mobile communications, right? Dealing with telecoms and media and some of the technology we're seeing today. Then the 2000s, emerging markets and the rapid urbanization of China, mining and consumer products took off. Then we had 2010, we had IT, e-commerce, and internet platforms really take off. And then 2020s, we're seeing this in healthcare innovation, a lot of the transition in energy, electric vehicles. And so you're seeing that over this long period of time, there's been different types of innovation. But that's the beauty of our economy and our entrepreneurial spirit, is that we continue to invest. We continue to reinvent ourselves. And that's what makes investing such a dynamic process and actually an exciting one, especially when you take a long-term view. When you take a short-term view, it can be a little bit scary. We recognize that. So we're going to do a little history lesson. So when we look at 50 years, basically, if you were born before January, I guess we can update this. If you were born before November 8th, 1973, you've already lived through 3 episodes in which the broad US stock market went down by roughly a half, so 50%. So these were the periods of time, and I know it was not exactly, but these are these great bear markets when they occurred. 1973, we had down 48%. 2000, which was the dot-com bubble burst, was down 49. And then October of 2007, down 57%. These declines were driven by real crisis. There were things happening in our economy that there was a reason for this. This wasn't your run-of-the-mill bear market, your run-of-the-mill correction. There were some real crises that were happening in the markets. So in the 73 correction, we're looking at an oil embargo, and we had inflation was exploding during that time. We had multiple recessions. We had multiple recessions in the 70s, but this was a recession during this period of time. Unemployment peaked at 9%, and we had Watergate. As we looked at the next period of time, March of 2000, we had the implosion of the dot-com bubble. The NASDAQ was down 80%. Think of that, 80%. From March of 2000 to October of 2002. We had a recessionary environment. We had Enron and a bunch of accounting scandals that were happening. And then that was also a time where September 11th was right in the middle of that. So markets lost 49% over that period of time. Then we went through the subprime mortgage catastrophe, the global financial crisis, and we had the longest and deepest recession since the 1930s. This was also known as the Great Recession. And unemployment peaked at 10%, right? So these were 3 very painful periods over the last 50 years. Now, this chart goes back longer than 50 years. This is about a 70-year chart. What this chart represents, the blue represents a bull market, which means a rising market, and the purple represents a bear market, which is a declining market. So when you look over the period of time, the recoveries last a lot longer than the downturns. And you can see, if you look here, it's starting at that 1973 period, you can see the bear markets that we've had. So while we're illustrating 3 bear markets over that period of time, there has been actually 7 bear markets, but only 3 of the magnitude of down 50%. And in each subsequent one, we had a massive recovery. And that has been the norm for our economy. And we believe that that's going to be the norm on a go-forward basis. But, all of these things will look differently on a go-forward basis. But this just is designed to represent that this idea of, over time, this will pass and this will make our way through the challenges that we have today. So a couple things to just cement home around the stock market, because I think a lot of times people think about the stock market and, they feel like, it's very volatile. I don't really have, while I know I'm buying companies, the whole idea of it is not a tangible asset, right? If I buy my house, it's a tangible asset. If I run my business, it's a tangible asset. I know what I have. When you're buying the stock market, you're putting your money into investments that you have really no control of. So at the end of the day, what drives the performance, or what drives the rising of the stock market or the declining of the stock market? And the reality is, over time, the markets will go up because profits of the companies that are in the market go higher. And so what this is designed to show you here is the index, which is the S&P 500 index, has gone up 32 times over the last 50 years, and earnings of these companies have gone up 35 times. So there's a very direct long-term correlation of as earnings grow and profitability grows, that will drive the index higher. And I believe it was Benjamin Graham, but I might have the wrong person, who is really the professor, the teacher of Warren Buffett. This could have been a Warren Buffett quote, but he talks about that in the short term, the stock market is a voting machine, and in the long term, it's a weighing machine. And when you think about a weighing machine, you're weighing profits. So over the long term, the profits are what matter. In the short term, these economic headlines are going to drive things, and they're very unpredictable. And that's why a lot of times we don't use those to drive too many decisions, because we know over time the weighing machines, the profit of the companies over a long period of time will provide those benefits. So then we look at is, okay, well, why has productivity, or so why have earnings gone up so much? Why has that actually occurred? And a big driver, if you look on the left-hand side, it shows productivity growth. Real GDP, so gross domestic product per capita per person, has gone from 26,000 to 60,000. So we've had massive productivity growth. The other thing is innovation. It's remarkable when you look at this. 9 of the 10 most valuable companies today in the S&P did not exist in 1972. It didn't even exist. So that's a big driver of what's the fact that the S&P is not stagnant. New companies are on there all the time, and that's part of investing. Then we look at another component, and we talk about dividends. So dividends, which is cash flow generated by these companies and cash flow paid out to their investors, have grown far ahead of inflation. One of the big believers of why we like stocks for the long run is that if you look at investing in cash, which is good for safe investments as well as parking money, but as a long-term investment, why stocks historically have provided to be a really good place to be, is that the cash dividends over the last 50 years have increased 21 times. And the consumer price index, which is a common use of as an inflationary index, is up 7 times. So the dividend that's being paid by these is substantially higher than what the CPI has been over that period of time. So a little bit of this, I know this is rhetorical because I don't have a live audience, but since the end of World War II, with dividends reinvested, what is the longest time to break even? And so why am I asking that question? Well, the biggest fear for an investor is, I invest today, the markets lose money. How long will it take me to get back? And that's really the fearful part of investing, is you have a period of a big loss, and how do I get back to break even? So the longest period of time over the last 50 years the break even was 5 years and 8 months, which was August of 2000 to April 26th. A really long period of time. And remember, this was just in the S&P. So if you were more diversified in other areas, like smaller investments using cash and bonds, the break even did happen a lot quicker. So the other thing in putting this together that this really resonated with me, this concept, is that, and this is really hard, I think, for the average investor to put their arms around, but it's important to remember when stocks decline that price and value move in opposite directions, right? So if you think about value is really defined as, is this a good price? And a good price to buy something at would mean, if I buy something at this price, will I get a good return? So we're going to determine, is this good value? Well, the reason why price and value move in opposite direction is that if the price of the stock market goes down, presumably value is higher, right? Because you're buying something at a cheaper price. And conversely, when price goes up, things get more expensive. So then value theoretically goes down. And so that's one of the things to really remember is we get scared about price declines, but that means there's better value in the market. And we love when our portfolios are higher. We love looking at the 401k when values are higher. We feel better, right? But at that point, because prices have really gone up and the portfolio has gone up, value is actually gone down. So meaning things are more overvalued. The stock exchange is the only place where when they have a big sale, everyone runs everyone runs out of the store, right? So it is counterintuitive, right? When you think about typical shopping habits, if you're going to go buy something and it goes on sale, you get excited about that. But when the stock market goes on sale, guess what? People aren't interested because there's a lot of fear out there and people are concerned that it can go lower. This is Charlie Munger, which is Warren Buffett's longtime partner at Berkshire Hathaway. If you're going to be in this game for the long pull, which is the way to do it, you better be able to handle a 50% decline without fussing too much about it. Now, I know that's a big ask for most people. Again, that's why diversification comes in. But if we do know long-term in equity markets, we can have periods of massive declines exhibited by just the three great bear markets that we have already shown you over the last 50 years. All right, so some key takeaways as we go through in our conversation today. So these are just really important things to remember. And some of you might look at this and say, oh, I'm not invested in individual stocks. But when we buy ETFs, mutual funds, those investment vehicles, whether it's in your 401k and your IRA and your brokerage account, those are all making investments in these fine American companies and fine overseas companies. But the shares of even America's finest companies have experienced frequent declines in price. That's happened, right? We know that. Some of these declines, driven by very real crisis, have been quite significant, which we know. Despite these setbacks, leading U.S. companies have continued to grow their earnings and dividends strongly over time. And finally, their shares have overcome even the deepest declines more rapidly than one might expect and gone on to new heights, right? So that's the whole idea. We get these corrections, but markets tend to recover and move higher. But again, we have to remember, past performance is no guarantee of future results. So one of the things, and what's nice, I think, going through, well, one of the things we have noticed about our clients and hopefully some of the education that we're providing through our webinars and just clients now having, working with us for, in some cases, a few decades, that there hasn't been much panic at all. Like I will get, my mom, when I do chat with her, she'll say, oh, your clients must be calling you nervous about what's going on. And so, yeah, they're nervous, but we've prepared them for these things. We know they're going to happen. It's not a question of if they're going to happen, it's more when. And so when we take that approach and we just acknowledge that this is part of being an investor, these are the big questions we have to ask ourselves is, this time it's different. So you're truly convinced that it's different, it's never been the same, and it's not going to get better, or this too shall pass. And I didn't put together a history of the, Time magazine headlines or covers, I should say. But if you look back at cover stories from the 70s and 80s and 90s, all the way up till now, it's pretty remarkable how they tend to repeat themselves with some of the scary and dire situations. And, we're going to have some challenges ahead of us. I do believe over the next 6 to 18 months, as we work through, the rising of interest rates, working through some of the excesses that we had post-COVID, there's going to be some challenges there, and exactly what they look like, nobody knows. Again, that's why we come back to why diversification is so important, to protect and to manage your money in a diversified manner. So we do believe this too shall pass. I'm really happy to report on a year where markets are positive. So we're not looking at this as we're looking at a year where we have losses, but we still haven't gotten back to. So we had losses in 2022, 2023. There are gains, but we haven't gotten back to the all-time highs in the markets, and we're going to probably be a little bit choppy over the period of time. But again, nobody has a crystal ball, nobody knows. And so the main way we approach this is, number one, we understand your financial goals, allocate your money given your financial needs, make sure we assess your risk tolerance appropriately, because in periods of volatility, if we don't do that, then it might cause extraordinary emotions, which cause us to not be a long-term investor. So those are the two really big things that we do, and make sure we have discipline around that. And that's what we're doing every day, looking out for our clients. You've seen this quote before. So Nick Murray is a really well-known person in our business, in the financial services area, especially financial advisors. But I just love this quote because I think too often investors will get caught up in, I'm worried about which way the markets can move. Is it going to go up 20% or down 20%? And his quote, and I don't want to fully butcher it, so I'll just read it. I don't worry about which way the next 20% move in the market will be, because I know exactly which way the next 100% move will be, and I can't run the risk of missing that move. And so it's a really clear point around, again, being a longer term investor and knowing that this too shall pass.